All right, so we are going to talk about a little bit of financial accounting. We're going to track these transactions through the general ledger account. All right, so here's an example. As we're doing this job costing, we're building up the cost per job, right? So here's job 101 ticket. We're requesting some direct materials, $1,000. So the accounting for this would be we credit materials inventory, debit work in process. So there's two jobs here, so there's 1,500. We already had 2,500 in materials that we'd purchased, and so here we're just moving out of one inventory into another inventory. So it's pretty easy. The flow is going to be debit when you purchase materials, then when you move to work in process, you'll credit materials, debit work in process, then when you move to finished goods, credit work in process, debit, it's just credit, debit. It's pretty simple. So we've moved our materials out and into work in process. Okay, now we got wages. Wages need to become part of our cost of goods sold. So we need to move our wages into the work in process, right? So as they accumulate, we move them into the work in process. So here's our wages payable. Here's our work in. Now this is for direct labor. All right, this is direct labor. Indirect labor would be overhead. All right. So how do we track over? Direct labor, direct material. Those are easy, right? Straight into work in process, which is an inventory, which is an asset. So it always increases with a debit. When we move things out of work in process onto the next inventory, which is finished goods, we credit them and debit finished goods, which is also an asset inventory. All right, but what do we do with accounting for overhead? Well, overhead we're going to accumulate in an overhead account, and then when we know how many labor hours or machine hours or whatever our driver is, at the end, when we know how many of those we've used for that job, then we'll apply the labor and we'll stick that in work in process and take it out of the overhead control. Okay, so you actually actual overhead accounts are getting debited to overhead control as they go along, and then you stick them in work in process. So here's how it looks. Something happens, we have depreciation. We have some kind of miscellaneous thing that we bought and we have a payable. All those overheads go into overhead control. All right. Then, at the end of the job, when we need to move that overhead according to the rate into work in process, then we just go ahead and credit overhead control and debit work in process. So now we've got our direct materials, direct labor, and direct overhead in work in process. So when that thing is finished, we can move it out in total to finished goods. All right. So here's a completed job order cost sheet, right? So we've made some street signs, so they're kind of unique thing. Everyone is different, right? So we've accumulated direct materials, we've accumulated hours, we've applied overhead at the direct labor rate, at the direct labor hours at $4 per direct labor hour. And so we ended up with a total cost of $18.40. And if you divide it by the number of street signs that got made, which was 20, that ends up being $92 per street sign. So that's a complete job order cost sheet. All right. Now, once you've got everything finished, like you've finished that job order cost sheet, and you know your overhead and everything has been sent to work in process, including your overhead, you're done. You've moving it to inventory, right? You're waiting for the people to come up and pick up and use their street signs. So everything gets totaled, and then you move it to finished goods inventory, which is just another inventory, another asset. Work in process is an inventory and asset, so to To reduce work in process, you credit. To increase finished goods, you debit. All right. Now, in order to make sure we've done it all correctly, we keep track and we make reports. And one report we make in cost accounting is a schedule of cost of goods manufactured. So we're keeping up with that finished goods inventory. And so what we do is summarize those flows, right? What was our beginning inventory? What do we manufacture? Minus our ending inventory will tell us our cost of goods manufactured. So finished goods are carried at normal cost. So that's your inventory. We have to do that the way GAAP says. So no matter how we do our costing, we do need to make that estimate up front so we can do normal costing, which means apply a rate. All right, so what do? Well, when you're done with your job, you transfer it to inventory, and you can imagine this, it's coming off the factory floor and it's going to go sit in the warehouse until it's sold, right? So here's your credit, here's your debit, and now it's in your inventory. All right. So in order to keep track of stuff, we report, the manager is going to want to report, what was our cost of goods manufactured this month? Well, here's the direct materials we used, here's the labor we used, here's the overhead we used, here's the overhead we applied, here was our beginning work in process, here's our ending work in process, so that means we manufactured this much. And we'll do one of these in one of the problems I work on the videos for you for chapter 5 problems. I think that's in 5.27. So if you watch that video, I'll prepare one of these. So when the job is shipped, you're done, right? We get to recognize the revenue when the goods are sold. So when they are sold, we're not really that concerned with the revenue part in cost accounting, but we are concerned with the cost of goods sold. So we care about the expense part. So what we have to do is move the cost to cost of goods sold, so now it's an expense. Cost is finally used up and it's an expense. So obviously you credit finished goods, you debit cost of goods sold, which is technically an expense. You increase expenses with debits. All right, now, sometimes you get to the end of the month or the year or whatever, and you find out, because you're doing normal costing and applying the rates up front, that sometimes you don't get it 100% right, and there's what we call a variance. Hopefully, you're good at your cost accounting, and that variance is not material. It's not in other words, it's not that big of a deal. Nobody's going to care that much. So as long as you have an immaterial variance, you can simply adjust cost of goods sold, because that's where it would have ended up anyway. All right. Now, if it's a big variance, you actually would go back and adjust not just cost of goods sold, but work in process, and if there was some other accounts that needed adjusting. But I think for purposes of this class, we can pretty much assume we're going to adjust cost of goods sold. All right, so here's your cost of goods sold statement, right? Beginning inventory plus goods manufactured equals goods available for sale, less ending finished goods inventory, normal cost of goods, under applied, adjusted cost of goods sold. So you just report out, here was our variance. In this case, they under applied overhead, and you just adjust it. And there's an adjusting entry. Of course, you would just debit or credit, depending on if it's over or under. And you just take care of that in your cost of goods sold. And there you go. So here's how it goes. From materials to work in process, wages to work in process, overhead control to work in process to finished goods to cost of goods sold, and take care of any variance through cost of goods sold. Not all expenses, or I guess I should say costs, but in this case we're talking about expenses, are become part of the cost of goods sold, right? So not everything is overhead, right? Some things are selling expenses, some things are administrative expenses, but we need to recognize those. They need to be on the income statement. You may remember from back in 2301 in financial accounting when we did a multiple step income statement, right? You'd have sales minus cost of goods sold equals gross profit, right? Then you'd take out selling and administrative expenses. So they're not part of overhead, right? Overhead is part of cost of goods sold. So remember, these things are period cost. They're not part of the inventory. All right. So here's an income statement. This is what I mean. Remember, sales, cost of goods sold, gross, less SG&A equals operating income. Should look pretty familiar. We'll talk about activity-based costing next.